Infinite banking concept is a process where we use a specially designed and engineered whole life insurance policy from a mutually owned company that pays dividends. And the purpose of this is we direct some of the money we would normally save through this policy, and we build high cash value. That cash value can be used for a lot of things, and it also accomplishes uninterrupted compound interest on your money. The specially designed and engineered whole life has some really unique features, and one of them is the ability where we can put money into it, earn a guaranteed interest rate on that money, and then we have access to take that money out without interrupting the interest earned on that account. So what's required to make this work? Well, first off, we got to have an insurable person. So because this is life insurance, specifically a specially designed and engineered whole life, we got to have a body to insure. The insurance company won't just give you a whole life policy without somebody to insure. So we got to have an insurable body. If you're not healthy, well, we got to find somebody that you can insure and you can be the owner of their policy, which means you got to have an insurable interest. So that's number one. Number two, well, we got to have disposable income to make your premium payments. Remember, these are specially designed and engineered. You want to be able to deposit as much as you can into these vehicles based on what you're currently saving today. And then number three, because these are specially designed and engineered whole life policies, you got to find somebody that actually knows how to build one that will work for the infinite banking concept. So you don't want to go to the insurance store and just find somebody that will sell you a whole life. You want to actually find somebody that knows how to do this, knows how to build these policies. Now, when you design one of these policies, whoever does it for you, you want to make sure that it's designed for cash value. And not just cash value, high cash value. Not death benefit. There's always going to be a death benefit, but the death benefit is going to be relatively low in comparison with how much cash value you're going to build. This is the opposite of how a whole life is normally built. Step number two, we want to open a segregated checking account. Nothing different than a regular checking account, but the only reason we want to do this is we want to use this for all of our banking use. So any money that goes through your banking system goes into this account and then back out. And the reason we do this is books and records. All right, step number three, what we're going to do is we're going to take a policy loan. It's going to be a loan against the death benefit. The loan comes from the insurance company, and they just advance you part of your death benefit while collateralizing that loan using the cash value you've built up. We're going to use that to pay off the debts. And this also is used in velocity banking. We want to start with the lowest balance. Not the highest balance, not the highest interest rate, the lowest balance, and then we want to go to the highest balance. Step number four, we're going to take the payments that we used to give away to those debts, the small debts we paid off, and we're going to recapture them through that segregated bank account that we set up, and we're going to put that money back into the policy as a loan repayment. You see, all we're doing is moving the money in a big circle. Let me show you. The money goes into the specially designed and engineered whole life. So these would be the premium deposits. Then what we're going to do is we're going to then take the loan from the policy using the cash value as collateral. And remember, the loan is just taking part of your death benefit. Then we're going to run that through that segregated bank account, and we're going to then pay off whatever debts we want. But if we paid off, let's just say a Visa, and you were giving Visa $100 a month, we want to recapture that $100 a month and move that money back through the segregated account, always going to stop there, and then pay off the loan balance. And in doing that, your money just continues to keep moving in a circle. But the one thing that didn't stop is the premiums you deposited in there never stopped earning interest and dividends, because the money you took out, the loan, wasn't your money leaving your account. The money you took out was the loan from the insurance company. All right, so step number five, what we want to now do is we want to make sure that we pay the interest to the insurance company, but this is only done one time per year. And we can do it using cash value, which I don't recommend, but some do, or we can just use it with leftover money that's in that segregated account. But we want to make sure we pay the interest on the policy loans every single year. Step number six, we want to repeat this until all your external debts, all your liabilities are completely paid off, and then all the money that you were paying to those external debtors is now ending up in your private bank. That is the infinite banking concept. It earns uninterrupted compound interest. Every dollar that you put through this specially designed and engineered whole life will always earn interest and dividends. And in doing that, your money is able to work for you even while you're using the money. That's the biggest pro. you can use this money tax-free, including all the money that it's made after years of compounding. The loans don't need to be repaid. This is confusing for people, and people really struggle with this. Remember, the loans are being made against your death benefit. So you're leveraging a death benefit, so therefore the loans during your lifetime don't have to be paid because the insurance company will just repay the loan upon your graduation. A nice way of saying when you die. The other thing that we didn't really cover is legacy. Now, for most of you, you have families, you have maybe children. The legacy that you create is done with the infinite banking concept because of a death benefit. No matter how much you use the money, you will always have a death benefit that's paid out to your beneficiaries of choice. So the legacy play here is paramount and not found in velocity banking. And my favorite part, control, control, control. You have access and control to that money without anyone having to say anything about it. You don't have to apply for it. You don't have to go to the bank and say, why did you lower my home equity line of credit? Your money is always available to you by a click of a mouse or a simple phone call, and you can get that money out anytime for any opportunity. So when we're really talking about control, that's a huge pro of the infinite banking concept. So what are the cons of the infinite banking concept in these privatized banking policies? Well, a couple. Number one, you got to qualify. They don't just give these things to everybody. You have to actually be healthy, or you have to have a body to insure. So there's an insurable interest that you got to find, or you just have to be healthy enough to get one of these policies and qualify for it. There's a cost for the cost of insurance. So whatever life insurance value that's on this, the death benefit, there is a cost for that, and there's a policy service fee, usually $50 to $100 per year. But again, when you really look at the numbers and how these work, cost is only an issue in the absence of value, and there is a lot of value provided. In the first few years, your policy will not be efficient. You're going to have access in the first year to 60 to 90% of the money that you deposit, like I mentioned earlier, and in the second year, it's still not going to be 100%. Now, although this might hinder some people from doing this, I have to ask, when you make deposits into your bank account, do you take all of that money right back out? Because I don't. You're always going to leave money in there. So if you don't have access to all of your money, is it really that big of an issue? For me, it's not. You got to treat your money the same as you treat the bank's money, and you're okay paying the bank's interest. So when you borrow money from your policy, you are paying interest on those loans. There's ways to reduce this. We can use lines of credit, commonly called a cash value line of credit, which would bring that borrowing rate from roughly about 5% down to anywhere between 3 and 4%. But we still have to pay interest on this money. So a lot of people really want to always try to poke holes in that. Oh, why would I use my own money and pay interest on my money? The reason is, back over here, your money never left your account, and it's earning a guaranteed interest rate plus dividends. And in all the policies that we design, the guaranteed interest rate and dividend is more than the interest that we're paying on that loan. So how would you like to be able to use your money, all of it or a portion of it, and still get paid more than what it cost you to use that money? For me, I love that. It's called leverage. This is why the wealthy use this. A lot of people think the infinite banking concept is a product called a whole life product, right? A whole life insurance policy. It is not. The infinite banking concept is a concept. It is a process. It is a process of moving your money the same way the bank does. It is you mimicking what banks do with their money every day. So just so we're clear that the infinite banking concept is a process, and that the whole life policy that we use, the specially designed and engineered whole life, because this is not your standard off-the-shelf whole life. This isn't you walking into the insurance store and saying, yep, I'll take one of those whole life policies. Yep, great. I'm going to go home and I'm going to start banking with that. It will not look anything like what I'm showing you. These are built for banking. These are specially designed. They are not what most people know as whole life. They are certainly not your Dave Ramsey whole life is the worst investment you can do, or your Susie Orman whole life is the worst place you can put your money. These are not those plans. These are the plans that were created many, many years ago, hundreds of years ago, if you will, back in the Rothschild and the Rockefeller days, where they were using these for banking. So now that we've got those things out of the way, let's get into the numbers. And these numbers, just like I said, are right off my newest policy. So I'm not changing numbers, but I did summarize those. So let's go into it. So the first year, I put in 30 and I lose 2466. Now that pretty much sucks. The second year, I put in 30,000 and I lose again. I lose 460. But you see how it's getting better? So for the first 2 years in my policy, I'm in a negative. And I want to ask you a question. How many times did you go to your savings account,
deposit money in your savings account or deposit money in your brokerage account, and then 30 days later, 60 days, 90, 6 months later, go and take all that money out. Very rarely. But if you are one that is going to put money in and take it all right back out, this is not for you. Okay. This is a long-term strategy that we call the marathon. This is not a sprint. Life isn't a sprint. Building wealth is not a sprint. It's a marathon. This is a marathon, and it takes a couple years to capitalize your policy. So what does that couple years look like in my case? Right here. Okay. The third year, I put in 30 and I make $896. Meaning I put in 30 and I can take out $30,896. Now that's looking pretty good, right? And if we keep doing this, see, here's the beauty. I don't care how you look at these numbers. Every single year that goes on after this point, I will have more money than I did the year before. Let me describe it like this. I want you to envision that you have a vending machine in your garage. And the first day that you got this vending machine, it's old, it's rickety, and you're like, I wonder if this thing even works. So you go over to that vending machine, you put $1 bill in the vending machine, it takes your $1 bill, and then it gives you your $1 bill back. And you're like, I knew it was broken. But then all of a sudden it drops a cup and it fills the cup full of coffee. So you got your $1 bill back, you got your coffee, you're like, that's sweet. And then you're just about to walk away happy, and you hear cha-ching, and it drops some change in the change drawer. You're like, wow, this thing's awesome. I got my $1 back. I got my coffee and it gave me some change back. So what would you all do with your vending machine? You're darn right. You'd go right back to that vending machine and you'd try it again. You say, honey, I'd say to my wife, honey, come out here. You got to see this vending machine. Let's see if it does it again. You put your $1 bill in it. It gives you your $1 bill back. And then you're like, awesome. And your wife's not amused. And then, or your husband's not amused. Then all of a sudden it fills the coffee up. Honey, look, I'm getting the coffee and I got my money back. You got your coffee and your money. And then all of a sudden you're like, wait, honey, watch. Cha-ching, cha-ching. It drops more change. And every time you do this, you start bringing your neighbors over. You start bringing your friends over. You start bringing your coworkers over to see your magic vending machine. And your vending machine does nothing more than give you your money back, give you the coffee, and give you more money than you did the time before. And all your neighbors are like, I want one of those vending machines. And you're like, I don't know. I don't think you can get one. Do you know what that vending machine is, folks? It's what I'm going to show you. It's privatized banking. Because every day after this third year, every day, this is that vending machine. I'll have more money than I did the day before. The coffee is the result of what we're going to show that this does. Think about that. This is the magic vending machine that you've always wanted for your money. So let's keep going. So year 4, I put in 30 and I got $1,716. So I got $31,716. And also, just so everybody knows, when I put this 30 in and I had $24.66, how much money could I take out? I could take out $27,534. That's right. I can take all of the money available in my plan. So in year 3, how much money could I take out? Well, in year 3, I could take out $30,896. And then the next year, I can take out $31,716, and on we go. It's just going to keep giving me more money. So the real question is, with the infinite banking concept, it's not so much that we should be excited about these, which actually you could, because let's just do the math, right? So year 1, your cash flow is negative $24.66. Okay, that's how much money you lost. So that would have been, let me get the right colors here. Year 1, you lost money. Year 2, you lost money. But year 3 on, we made money. Every single year, we were in the plus. And it's just going to be plus and plus and plus and plus. And these never end. They end the day you graduate. And I don't mean the day you graduate from college. I mean the big graduation date, folks. The day we go to our final resting place. I just don't like to say die. Okay? So plus, plus, plus. That's pretty good. We lose for 2 years. That kind of sucks. I'm not real psyched that I lost money for 2 years. But you know what? To lose money for 2 years, to have that vending machine pay me every single year, I'm not upset by that. And by the time we get to year 5, okay? By the time we get to year 5, we have made 10.9% on the money that year. Now, this is my cash on cash return. Just so you all know, there's 2 ways to figure your return. Some of you would take the total amount you put in and then take the amount that you have. So if we, let's see, let me grab my illustration. So by year 5, we have put in 3 times 5, okay? So by year 5, we have put in, let's see, let me just come over here. Year 5, where am I here? We made 10.9%, but year 5, I've got $152,000. $714. That's how much I got. We put in 150. Okay? You put 150 in, you got 152. Now that's not that great of a return, but it's pretty good. It's better than you're getting in a savings account. It's better than you're getting in CDs. It's still a good return, but that's not the right way to do the returns here. You see, each and every single year that I put money in, I can take that same money out. And if over here, I'm making 4% plus the dividend, which in this policy, the dividend plus the 2020, so I want to be clear, this is 2020. I earn a guaranteed 4% and I get a dividend. How much is my dividend in this plan? 2.2%. Okay, so 2.2 plus 4 is 6.2% that I'm earning. Okay, so I'm making 6.2 in 2020. That can change in 2021 and 2022. It's non-guaranteed. Okay, but my money's growing. I put 150 in the 5th year, and then over here I got 152. But if I took out this $27,000 in year 1, in year 2 I took out, let's see, how much money would I have? I know I did the math on this. Yep, here we go. If in year 2 I took out $29,540, how much money could I make on that $27,000? How much money could I make on that $29,000? Because here's the beauty. When you take money out of this plan, you don't stop earning that 4% plus dividend. So even though I've got 150 in, let's say I took all 152 out of this plan. And that 152 that year, my $30,000 deposit, my cash on cash return, my 30 grand made me 10.9%. And how do I figure that out? Well, I look in the 5th year, my plan made, so let me just kind of go here. I'm just going to make these numbers. My plan made $3,028. Okay. So if I take $3,028 and I divide it into 30, that's 10.9%. That's how much money my money made that year. So if it made me 10.9 and I put in 30 and I got 33,000, could I use that to pay all my household expenses? You could, couldn't you? Because if you're making more than what you're depositing, you essentially would be ahead of the game if you used this to pay for your groceries, if you use this to pay for your utilities, if you use this to pay for your insurance. This would make sense if that's the only thing you have to use this money for. But I bet you any money, there's a lot of other things you could use this money for that would make you more money. You see, the key to this is you got to treat your money the same way you treat the bank's money. Would you ever go to the bank and borrow money from the bank and use that loan to go buy groceries, to pay your car insurance, to pay for your vacations? Maybe you would, but probably not. You'd use your earned income for that because it's not effective to borrow money and use it to pay for household expenses. But would you take a loan out to buy your car, your boat, your house, your rental properties? Yeah. So if the bank's money wouldn't be used to pay household expenses, why would you use your bank's money to pay for household expenses? You probably wouldn't because you can make more money on it. So I already explained, if we took out $27,000, we didn't stop the interest. Okay, we're still earning uninterrupted compound interest even though we took the money out. But there's a catch. There's a catch. When we take that money out, okay, the insurance company is going to keep 5% simple interest. Okay, so if the insurance company is going to keep 5%, really what's my net? 1.2 in this scenario, gross. But let's go over here. If I made 10.9, okay, if I made 10.9% by the 5th year, so by the 5th year, I made 10.9 cash on cash, but I got to give back 5. I'm ahead of the game now, 4.9%. Or no, I did that wrong. But you get the drift. So I'm ahead of the game. I'm ahead of the game, 5.9. If I'm doing my math right, hopefully that's what it is. But this gets so much better. Let's keep going, folks. Let's keep going. And then I promise I'm going to answer the question of why should you not use this money to pay for your expenses? The answer is because you can make more money, and I'm going to get to that. But let's keep going down here. So we already went through those, and you can see the numbers keep going up. So by the 5th year, I made 3,028. By the 7th year, I made 3,607. I just jumped ahead so I had room. By the 8th year, I made 52. By the 9th year, I made 8,861. How much of a return is that? By the 8th year, my return, my cash on cash return is 17.5%. Divide 8,861 into 30. That's right. I made 17.5% cash on cash. And why would I use cash on cash over cumulative? Because each and every year, I'm going to take this stinking money out and I'm going to go use it for something to make more money. Now, what would that be that I'd use it for? Well, you got any credit cards? Yeah, I bet you most of you have credit cards. Some of you might even have $27,000 in credit cards. What if you took your $27,000 out of your banking policy and you paid off your Visa that was charging you 20%? And you took the money you were paying Visa, let's call it $300 a month, and you paid it back to your policy. You just made yourself a 20% return. Plus, you made the spread of what you're earning, which over here, okay? So whatever year, in the first year, you're actually at a loss. So you'd be about 1.2%, but whatever year, let's use year 10. If I took the full amount out in year 10, okay? If I took this 152,000 out and I paid off debt, I paid off my credit cards, I paid off my lines of credit, I paid off my mortgage. I paid all that off with that 152,000 by year 5. If I looked at the blended return of or blended interest rate of what I was paying those credit cards, those mortgages, those lines of credit, I bet you it'd be over 10%. So by me paying all those off and by me making the spread, I'm making money twice because I'm going to recapture the money that I was giving to all those debtors. If I was paying the mortgage company $800 a month, I'm going to pay myself $800 a month. If I was paying the credit card company $300 a month and that was 20%, I'm going to pay myself $300 a month. I want to treat my money the same way I treat the bank's money. And if I take a loan for $152 from my bank, I'm going to pay my loan back to my bank at the same rate that I was paying their bank back at. It just makes logical sense. Okay, 17%. But then as we keep going down here, let's see, year 10. So year 10, we made, and I got to move these up a little bit, 17.5 here. I was down 17.5. That's our cash on cash. Then year 10, okay, year 10, I made 29.5. Nothing changed, folks. But how did I go from 52.58 profit, okay, to 88.61? I'll tell you how. The full amount that I put into the plan is the amount that I'm earning interest and dividends on. And it never stops. Remember the vending machine? Every day I'm making more money. Every year I have more money than I did the year before. It's called compound interest. But in this case, it's uninterrupted compound interest because I'm able to take my money out without interrupting the cash return I'm getting, without interrupting my compounding effect. There's nothing else that I know of that does that. If you know something that does that, please let me know. I've been looking. But as of right now, these specially designed and engineered whole lives are the only vehicle that will provide you uninterrupted compound interest, access to your money without interrupting the interest you're earning. Your bank doesn't let you just go take all the money out of your bank. And when you take all the money out, they just keep paying you an interest rate on that money. It doesn't work that way. The bank doesn't even just say, hey, keep your money in the bank. We'll give you a lower interest rate loan because the bank's paying you less than 1%. Can you get a loan for the same amount or less than what you're earning in the bank account? No, folks. But can you take a loan from the insurance company for less than what they're paying you? Yeah. 6.2% with dividend. Again, non-guaranteed. And I pay 5%. That's exactly what they're doing. It'd be like your bank giving you a loan for less than what they pay you in interest. Banks would go out of business, but insurance companies wouldn't because they don't operate that way. But a lot of people are like, yeah, Chris, but if I take loans, if I take that loan for the 152,714, I don't want another debt. I don't want to take money out of from the insurance company. I don't want to take a loan from the insurance company. I'm trying to pay off debt, not incur more debt. I love that. Because if you understood how this works, you would understand that the loans never need to be paid back. Although we're going to show you paying them back because you got to treat your money the same way you treat the bank's money. You don't have to pay that loan back. The insurance company not only guaranteed you 4%, okay, but the insurance company also guaranteed to pay a death benefit upon your graduation date. That's right. So when you take a loan, all the insurance company is doing is reducing your death benefit. So if I took a loan for 152,714, my death benefit drops by 152,714, or maybe, some amount around that. All I'm doing is I'm leveraging a death benefit. And I've never met somebody in my life that cares more about the money that somebody gets the day they graduate than they do about the money they have to use today. So what this does, what the infinite banking concept does and privatized banking does, is gives you access to your money without you having to interrupt your compounding. I'm going to show you how I learned to buy cars. And I learned it from someone by the name of Brent Kessler. Okay. And he showed me this and my eyes went, I literally looked at that and I'm just like, oh my God,
There it is, the dollars and the idea hit me. I was so pumped about this because I'm like, I can get all the money back for all those Audis that I've been buying. And I didn't know about this before. That's where the story begins. So now what I'm going to show you, and I want to be clear about something. I want to be very transparent about something is this system I'm going to show you doesn't mean that when I show this to you tomorrow, you're going to be able to go buy a car in this way. This system takes a little bit of time to capitalize, and you're going to see that. Not a lot of time. I'll show you my system. All you need to do what I'm doing is change one thing. And that one thing, we'll get into that, is where your money goes first. That's it. It's where your money goes first. You're already doing this, folks. You're already doing this. You're giving money away to somebody else every single month for your lease payments or your car payments right now. True or true? We are. You're already giving up money every single month for your cars. Some of you are giving up large chunks of money every 5 or 7 years to pay cash for a car. And some of you are giving up monthly payments to rent your car, commonly known as leasing. But we're all doing this, okay? And the other thing that we're all doing is all of us have some method in our lives of saving money. So all of you are saving money somehow, some way. Think about it. Where's your money going? Okay? So you get your paycheck. It's netted out for taxes. Netted out for taxes, and then you get your net paycheck, and then that net paycheck goes places. The car payment, the mortgage payment, the car insurance, all those things. But some of that money makes its way to a savings vehicle. You can see the evolution. We went from a $20,000 car to a $45,000 car to a $63,000 car during different periods of time in my life. The $63,000 car just happened at the end of last year, 2019, and that is my wife's car. It's not my vehicle, it's my wife's vehicle, okay? It was the car she wanted. I'm gonna talk about that as we go through it. So those are the 3 different cars that I bought. Now, this is how most people would do this. Now, we know that there's these different options to buy the car, throw out the stealing the cars, because we're not gonna go into that, but conventional financing. Getting into it, car number 1, that was how it shook out. So I took a loan for $20,000. It was a 5-year loan at 5% APR. This isn't how I bought it, but this is just how I summed it up. So that was the vehicle, 20 grand, 5-year loan, 5% interest rate. The payments, $416 a month, $5,000 a year. Total amount you would pay in interest on a $20,000 car financed with a conventional bank over 5 years is $2,917. So that would be the first car. So what is the second car? The second car is that $45,000 Audi. 45 grand. If you finance that at a bank, a conventional bank, it would be a 5-year loan. Now, why does the interest rate change? Well, folks, this is real life. 2007, interest rates were higher than they were in 2012, correct? Think about that. 2012 was right after the Great Recession. The Fed dropped interest rates, so 3% was actually a pretty common thing to buy a used car and pay 3%. So I just want you to see a $45,000 loan for 5 years at 3% is $875 a month, $10,000. And also too, you can see right down at the bottom, folks, just to be full transparency, in case any of you grab these numbers, go to bankrate.com and you're like, Chris, those aren't the real numbers. Yes, they are. They're right off bankrate.com, but we included tax and title. Can you buy a $20,000 car and not pay tax on it? No, absolutely not. So folks, these numbers, these payments include the taxes on the car in New York State, which is, I believe, 8.25%, and registration of the vehicles. So I went all out. We didn't miss a beat on this. So that second car, if you finance that $45,000 car over the full 5-year period at a low interest rate of only 3%, you still gave the bank $3,806. $3,806. Now let's just do some quick math. I want you to understand this. Now that might not seem like a lot. You're like, actually, that's pretty good. The interest rate's really low. I would do that. 3,806 divided by 60 months. Folks, you're giving up $63 every single month in interest. Now that may not seem like a lot, but let's put all this together at the end. And folks, it adds up super quick. It was a 6-speed. Thank you, Adam. So that's the second car. What is the third car? It's my wife's SUV, which we'll get into the types of these cars, because this one is not an Audi, but it is an evolution of Audi, owned by the same company, but a little bit different. It is a Porsche. Okay, so the principal on this Porsche was $63,000, 5-year loan at 4.5%. is $1,084. And actually there's a typo there. The one thing that you're seeing here, and I want to be clear because I know these things very well, this should be a 6-year loan, because a $63,000 car, most people are going to do a 6 or even a 7-year loan. So that shouldn't be a 5-year, it should be a 6-year loan. We'll change that slide. But right there, over 6 years, your payment would be $1,084, $13,000 a year. You just gave up $9,758. So now let's just do this. 9,758 divided by 72 months means you are paying $135 every single month in interest to somebody else for a vehicle that's going to depreciate. That's what I want you to start thinking about. It's not about the car payment. It's not about the car. It's about how much money you're giving away to everybody else. And we got to change that one thing. And that one thing will then allow us to put that money back into our banking system. The total interest that you had paid for these cars, 5 years, 10 years, and 16 years. So 16 years worth of car ownership, 3 cars, you gave up $16,481. $16,481 over 16 years. So 16 years divided by 12 months. Well, we're not even going to, it's not even important, but that's how much money you gave up to the banks. Okay. And what did you do with the cars? Well, you drove them, you used them. Some of them you crashed, some of them you sold. You did different things, but it doesn't matter. The bank, without having to do anything, without having to work any harder, without having to really do anything other than make you a loan, made $16,000 off of you over that time frame. Sure, many of you are thinking, cost of doing business, Chris, cost of car ownership. Yes, until you learn this. Now, here's my way. So this is how we buy cars now. This is how Hannah buys her cars. This is how Brent buys his cars. This is how I buy my cars. This is how Adam's going to be buying his car. And this is how many of you are going to buy your cars. So watch closely. Now, in order to buy cars, okay, you have to, if you're going to pay cash for a car, you'd have to save that money. So back when I did this, and just so everybody knows, what we're looking at here is just a privatized banking system. Now, in 2007, I had banking policies, okay? They weren't like the ones I designed today, but they were still banking policies because I was in this business, so I had these. And what are these things? For those of you that don't know what we're talking about, what we're looking at here, these deposits, okay? I don't care if it's a bank account that you want to do them from, but I want to get uninterrupted compound interest. So what we're looking at here, and let me kind of get my little drawing tools out, okay? What we're going to kind of focus on is this deposit right here. 18,000, which is $1,500 a month, okay? 18,000 works out to be $1,500 a month. Where did that $1,500 a month that I was saving? Because it is a deposit account. So I was depositing the equivalent of $1,500 a month into a series of different banking policies. So what is a banking policy? Some of you might be asking. It is a specially designed and engineered whole life insurance policy from a mutually owned company that pays dividends. Not the normal whole life like you would buy off the shelf at your life insurance store. These are built for banking. They're built to operate and work much like your conventional savings account does, okay? However, unless your savings account pays you a guaranteed 4% plus dividends every year, your bank account doesn't beat my bank account. Now, there's a downside to my bank account. So your bank account, actually, if you're using a conventional bank account, which most all of us have, including myself, if you're using a conventional bank account, if you go to the bank and you deposit $1,500, the first year you have access to $1,500 because you're probably not getting any interest, right? In my banking system, the one you're looking at here, in the first couple years, I don't have access to all of the money that I put in. But it's really okay because if you're saving money in a savings account, how many times do you make a deposit and take all the money out? How many times do you do that? Very rarely do you ever deposit money and take all the money out. So this account, I put in $18,000 in the very first year. Okay, after I put in $1,500 a month, I have access to roughly 61% of my money. Okay, $10,990. So that's how much money's in my savings account. So most of you would be like, yeah, but that's not 18,000. I'd rather put money in my bank account, my regular bank account. Okay, so if that's what you're thinking, great. But just stay with me because your regular bank account doesn't pay you uninterrupted compound interest. So I did this for 3 years. I put in 18,000 year one, 18,000 year two, and in the third year, as I was making those deposits, what I did is I took a $20,000 loan from my specially designed and engineered whole life policy. From here on out, for the rest of this training, I'm not going to call it a specially designed and engineered whole life because it doesn't just flow off the tongue. I'm going to call this a banking policy. Okay. Just like my bank account, this is a banking policy. So I took 20 grand out, and what did I do with that 20 grand? I bought a car. Now, I showed you in the prior slide, if I had gone to the bank and financed the car, I would have had to make monthly payments for that car. But what I did is I was just saving money every month. Okay. I just saved between multiple policies because this isn't just one policy. This is several policies. I basically had been putting money away into these different policies for many years. So I basically had put that 18 grand in. And at that point in time, I would have had, if you added these two numbers up, I would have had $40,603 in my account at the end of the third year. But somewhere in that third year, what I did is I took 20 grand out. Now, I want to be very clear because I'm just showing you how to buy cars. Here's the reason why I use these specially designed banking policies. You see, this $40,603 that I have in my account that is earning a guaranteed 4%. That's 4% interest is what I'm earning on that money right there on this $40,000. Sorry if it's a bit scratchy in terms of how it looks, but that 40,000 is earning 4% plus dividends. So the number I use for this policy is 6.2 because that's how much the dividend and the interest works out to be today. So my money in this plan is earning 6.2%. Now, dividends are not guaranteed. We are using non-guaranteed values here, but the dividends are what they are and what they have been. Matter of fact, they were lower back, or they were higher back then. So I'm just using today's numbers. So if I took 20 grand out, so if you had 40,000 in your bank account and it was earning 6.2%, you went in and you took 20,000 out, how much would you be earning interest on? Well, 20,603, right? That's how much interest you would be earning. You'd be earning interest 6.2 on this amount. But how much am I earning interest on? I'm earning interest on the 20,000 that I took plus the 20,000 that's in. So the full 40,603. So how can you do that? How can I earn interest on 40,000 when I just took 20,000 to buy a car? Well, this is where the magic starts. And I have another video that teaches that, but the insurance company gives me the ability to use their money. So I take a loan from the insurance company's general account, which they've got way more money than I do. And the insurance company just uses my $20,000 as collateral, but they agree to continue paying me interest and dividends on the full amount. They're agreeing to pay me interest and dividends on this full 40,000, even though I took 20 out. So that is key. That is very important as to why this way of buying cars works so well. You see, what happens is in the first couple of years, it's not going to make a huge difference. But over time, what you're going to see, I have a perpetual tailwind. What is that tailwind? It's something Albert Einstein called the eighth wonder of the world. Okay. Something that he said was the most powerful thing in the financial world, or the financial universe. It is called compound interest. But you see, what I'm doing is I'm earning uninterrupted compound interest because this money that I have never stopped earning interest even though I took it out. So I just wanted to help you understand what's happening because I really just want to show the mechanism of how this buys cars. But you need to understand that there's always going to be interest and dividends paid on my full amount, not the amount minus the car purchase that I made. So if we do that and we basically look at these numbers now that you understand kind of what's going on, I took 20 grand out, but now you see this $5,000 car loan payment? You're probably thinking to yourself, why would I have a car loan payment if I paid cash for the car? Well, because this is my bank, folks. This account that you're looking at, it's my bank. I treat my money the same way that I treat the bank's money. And when I borrow 20 grand from my local conventional bank, they don't just say, hey, Chris, you can have the 20 grand, don't pay us back. Do they? No, they say, here's 20 grand and here's the monthly payment of $500, or in this case, 416, I believe it is. You got to pay us 416 a month. So if I was okay paying 416 a month to their bank, why would I have a problem paying $416 to my bank? The 18,000 that I was saving every year was already money that I was saving already. It's not new money. It's not like I had to go find that money. It was money that was going into my savings already. It was automatically taken out into multiple policies.
So the $5,000 you see on there is that $416 that I would have given to the bank if I took out a car loan. Now I just pay it to myself. And folks, this is the fun shit. Excuse my language, but paying yourself is way more fun than paying the bank. And here's why. You see this $5,000 every single year? Every single time I pay myself $416.16 to drive my car, I put $416 a month back into my account, okay? So that $416 goes back into my value. Every penny of that $416 is mine to use tomorrow when that check clears. How much more fun is paying $416 a month to yourself and getting to use it versus giving it away to someone else to drive the car? It's way more fun. And it works way better because, hey, when you become the bank, when you actually start taking back control of your money and stop giving it away is losing control. Taking back control is paying yourself. So I'm just paying myself every single month the same amount that I would have paid a conventional bank to buy this car. So what is the outcome? So what happens? So I've been putting $18,000 into this savings program, right? And it's not 18 all at once. You know, you could do it all at once. I did it monthly, which worked out to be $1,500. It was actually several accounts. So I did about $500. Okay, let's just round it and make it easy. $500 a month into 3 different accounts. And that was okay for me to do. I could afford to do that. Okay. And even though back when I did this car, I didn't have a ton of money, but I was still able to save. I've always been a good saver. And all of you should be as well. So what happens now is as we kind of move through this, you'll see we have put some money into our account. So how much money do we put into our account? I got to get my clicker to work. There we go. So over 7 years. So the first 2 years, I had to capitalize my account. So if you were looking to buy a car tomorrow or this year, you would have to pre-capitalize your account. You would have to dump money into your account all at once to get it ready to buy a car. And people do this all the time. But the way I did it is I just put money in every single month and I saved up. And when I had enough money to buy that car, I actually had more than enough money. I took 20 grand out and I used it to buy this car. And so over 7 years, the first 2 were just capitalizing. The other years were just me contributing and depositing money in my savings. I put a full $127,000 away over a 7-year period of time. It seems like a lot of money, but folks, when you break it down, it's really not. It's what all of us are probably putting somewhere else anyway. Then how much money did I pay back to myself? $5,000 a year. Okay, $416 a month for that car payment, but the car payment got paid back to myself, so that was $25,000. So 126 plus $25,000 was $151,000. So into my banking system, I deposited with the deposits and the car loan repayments, $151,000. There's the car. It is I don't remember what year that was, but it was a Audi, and actually that was an Audi A8. It was a several-year-old Audi A8. I don't remember, how many year old it was, but it was a $20,000 car. Had lots of miles. You see, one of the things I always did with my Audis, I wanted the nice one. That's a beautiful car. But that car had well over 100,000 miles. Otherwise, I couldn't have got that car for 20 grand. So I only wanted to have the car for a period of 5 years. The thing broke down all the time, but that's beside the question. Let's see, pay it back monthly to yourself, your banking policy. Correct. So I've got some questions, and let me just take a moment and in a second, and I'll answer your questions. I just want to finish my thought, and then we'll explain it. So I put $151,000 into my banking system, $126 in deposits over 7 years, $5,000 a year or $416 a month because everything is monthly, $25,000 for that car. So over 5 years, I paid $2,000 or $20,000 for the car, but with financing, it cost me roughly $25,000. I rounded up. So, but then out of that $25,000, what else happened? I had to buy the car, didn't I? So out of the money I put in there, the 151, I took 20 grand out and I bought the car. Therefore, my net injection into my banking system, which is the deposits I was making just on a regular basis, okay, for no apparent reason, I was just saving money for the future. That was the 151 plus the car payments, okay, which was the 5,000 a year, minus the car was 20 grand. I put a net injection of 131 into this banking system. And during this period of time, I drove that beautiful car right there. Okay, that was at my house out on Cherry Street in Lockport, New York. That driveway right there was filled with these little Audis because that was my little bad habit. But this car, The cash value growth after the purchase of this car. So now let's look at the cash value. Let's focus just on this column here, cash value. After 7 years, how much money do I have in my bank account? 116,343. 116,343 is in my account. So how much did I put in? 131. How much do I have? 116. So I literally, for that car you're looking at, this is the very first car I bought with this system. That car, that Audi A8, whatever year that was, I got 89 cents back for every single dollar I paid for that car. And I still, you got to remember, after the end of this, I got 89 cents back for the car, but I still owned the car. A lot of people confuse that and say, well, wait a second. Yeah, you got 89 cents because you sold the car. No, no, no. The car was in my driveway. I just got 89 cents back for every dollar I paid for it. Now, let me ask all of you a question. How many of you have ever bought a car, had the car for 5 years, and then had 89 cents back for every dollar you paid for that car, plus the car was still in your driveway? Well, very few people, unless you're a car collector or you're somebody that buys cars and renovate or fixes them up and like gets the equity back, most all of you have never actually even known how to get 89 cents back for every single car you've ever bought, driven, and owned. So that's not too bad. But here's the problem. That's not 100%, is it? I said I'm going to show you how to get every dollar back for every single car you buy, drive, and own. And now we're going to go on to car number 2, but let's come over here and just hit a couple of questions real quick. So first, when and how do you have to repay the $20,000 back you took out of your policy for the car? So that's a good question. And I did answer that, David, but that's okay because a lot of people probably have that question, but they maybe haven't yet gotten to the conclusion of that. So remember, this $416 a month that I'm giving to my banking policy, I'm taking that $416 every single month and I'm depositing it back into my account. I'm repaying this loan that I took from the insurance company. But when I repay the loan, my value goes back up. The access to my capital goes back up. So all I'm doing is I'm just repaying myself the exact same way I would repay a car loan with the conventional bank, dollar for dollar, same terms, same monthly payment. Nothing changes with what you do right now when you buy cars if you're financing your cars. Exact same strategy. So if you want to change one thing, if you want to take back control of your money forever, if you want to do what they've been doing for hundreds of years to control their money, what the wealthy have done, what the corporate or the Fortune 500 and 100 companies have done, what every wealthy person, including the gentleman, Aaron, who was on my podcast yesterday, who knew nothing about me, we got into a conversation and boom, you know what he was doing? He was doing what I'm doing. And I'm like, holy crap, Aaron. I'm like, you don't know anything about me and you have no idea that I teach people how to take back control of their money by doing exactly what you just said you've been doing. And you just described what you've been doing as something that changed your life. That one change of not using banks and using mutually owned insurance companies through a 200-year-old system, infinite banking concept, privatized banking, whatever you want to call it, be your own bank, that system puts you in control of your money. Now, is there other issues with that? Yes, but they are nothing compared to what the issues are with you not being in control of your money. And what are the problems with the infinite banking concept? What are the biggest, I always try to find the worst possible things, the things that people aren't talking about because everybody wants to talk about just the good of infinite banking. Well, there's some bad things, but you know what? Let's talk about them. I did an entire Facebook Live, an hour and a half, trying to debunk and downplay infinite banking, and I failed. I failed miserably. And here's what the problems are. Here's what we came to after an hour and a half between me and Brent going back and forth trying to find as many bad Reddits, as many bad articles on YouTube, on Google. We tried finding the dirt on the infinite banking concept, which if you don't know what the infinite banking concept is, go right there, chrisnaugle.com/resources and watch my videos. They're free. They're not selling you anything. They're just teaching you how to change that one thing so that it puts you back in control of your money. But here's the bad things that we came up with. Number one, not everybody can qualify. So you don't need to qualify. Well, you kind of do, but you really don't need to qualify to walk into your bank to open a bank account. But you know what? Now that I think about it, you do. But anyway, with these banking systems, the infinite banking concept, the privatized banking that I'm talking about, you have to qualify. Okay, you have to be healthy. The insurance company has to qualify you through underwriting. So you have to get qualified for this. So not everybody can get it. But you know what? If you don't qualify, guess what? You have solutions. You have options. Find a body to insure. Find somebody's life to borrow, a child, a spouse, a business partner, somebody that is healthy enough to get qualified, because you don't need to be the insured. You just want to be the owner, because with ownership comes control. And what are we talking about? We're talking about you taking back control of your money. Ownership equals control. So that was the first bad thing. But the second bad thing, I think, is the worst one. But when I tell people this, they're like, oh, that's no big deal. But I'm like, yeah, but that's like the worst thing about this. So what is the worst thing about the privatized banking concept or the infinite banking concept? Well, here's what it is. In the first couple years, depending on how much you're putting away, depending on how we build the plan, you in year number 1 will only have access to your money immediately in the first 30 days is what I'm talking about, to roughly 60 to 90% of your money. Whew. That sucks. That sucks. I put money into this plan and I can only take out 60 to 90% immediately in the first 30 days. Damn it. Well, that's not going to work for me. Some people would say that, but then think about what you do with your bank account. This is where that's not a big deal, and where I started to actually have to talk myself off the ledge of thinking that that's such a big deal. People would say to me, yeah, but Chris, I get it. We can't use 100% of our money immediately, okay, in the first year, and a little bit more in the second year, but pretty much we have to wait like 3 years to have access to all of our money. But Chris, it's fine, because when I put money in a checking account, or when I put money in a savings account, or when I put money at Schwab, E-Trade, TD Ameritrade, any of those, I don't put my money in and take it right back out immediately. I don't take all my money back out. I put it there and I use what I need, but I don't take every penny of it. And I'm like, that's a really good thought. How many people actually go to the bank and deposit their money in their savings account? Because remember, this isn't going to function like a checking account. It's going to function more like a savings account. The infinite banking concept, how I look at it, is a better bank account, a better savings account for that matter, because what it does is it pays you a guaranteed 4%. What is your savings account paying you? Does your savings account pay you 4%? I think not. But then when you want to take your money out, you only have access to 60 to 90%. That to me is the worst part about this. Then what is another bad thing that we discussed? So this one really wasn't a big deal. Are there fees for doing an infinite banking concept? Yes, of course there's fees, right? The insurance companies don't work for free. So how much is the fee? Well, let's pick a company like Mass Mutual. The fee, the policy service fee. Get ready for this one. Hold on. This is a whopper. $50 a year. That's how much it's going to cost you in fees. The policy service fee for an infinite banking policy with Mass Mutual is $50 per year. That's a real killer, right? You pay more than $50 a year in your bank account in NSF fees and hidden fees, do you not? When you go to the bank and you take a loan from the bank, do they charge you a fee? You're damn right they do. And they charge you interest. Well, the insurance company, when you take your money out, they charge you interest too. But the interest they charge you is less than the interest you're making because of compound interest and simple interest. We explain this in the video. Watch the videos on my website right there, chrisnaugle.com/resources. Watch the video. I teach you all about this stuff. But, those are the worst things. And then there's a cost for the insurance. The cost for the insurance. Some people get wrapped up in this. The cost for the insurance, when you watch the video, is already in all the numbers. Cost is only an issue in the absence of value. And when you see that video, you'll see the value. The cost for the insurance part of the infinite banking concept, I'm not saying it's irrelevant, but it certainly isn't something that affects your growth. It isn't something that kills this system, not even close. Matter of fact, you will laugh when you see the returns that you would make with this one change you make in your life, from going from banks, from a cashless society, to being in control of your money by doing what the wealthy do. The wealthy, like Aaron, who was on my podcast yesterday, who use the infinite banking concept. There are so many people using this system and you don't even know it. Let's start from the top. I don't get into politics. I hate politics. I don't talk politics, but I just want to point out some people that are in the news every day that use this system. Joe Biden, McCain, okay, just to name a few. Walt Disney, JCPenney, Sears, okay, Ray Kroc, Just to name a few, I could keep going on and on, but those are just a few, but there's a lot more. Aaron Chapman, the guy that was on my podcast yesterday, yep, he uses it. And every single wealthy individual I meet in a discussion, I find out, oh, you're using this too? I'm in a mastermind out in Cabo and we're in the hot tub and we're just chatting. He's like, yeah, I use this infinite banking thing. I'm, you too? It's just like, it's almost like a secret club of people that learned the truth about taking back control of their money. And they learned what the wealthy have always known. But when they learn it, they're like, oh my God, it's like finding the Holy Grail. You just learned how to take back control of your money by just changing one thing. And what is that one thing? It's where your money goes first. I'm going to end with this, because I know all of you are probably getting sick of me ranting, but I want you to really consider what we talked about here today. And I want you to share this, share this, share this, share this, share this.